Dear clients, I'm Richard, Senior PhillipCapital dealer. After trading lower month-on-month in January, US equity benchmarks recovered handsomely last week, supported by some favorable earnings and economic reports, as well as an oil surge. As a result, the week's gains helped the benchmarks reclaim back close to flat or modestly positive territory for the year to date. On the economics and corporate news front, last Friday's non-farm payroll numbers smashed market expectations and boosted investor sentiment. Not only did the Labour Department report that employers had added more jobs in January than many expected, job increments were also revised substantially higher for the previous months. Additionally, it is noteworthy that a rebound in Jan's wage growth also paints a potential recovery in retail sales in the coming months. On a similar note, earnings reports were brightening up somewhat, and hence easing the headwinds, undermining investors' confidence at the start of the earnings season. Analytics and data firm FactSet is now estimating overall earnings in the S&P to grow 3% in 4Q14, not robust when compared to the roughly 8% predicted just a few months ago, but much better than the negligible 1% growth expected earlier in the reporting cycle. Furthermore, a booster short was injected for equity investors in the healthcare equity segment, as the prominent merger news between rival drug makers, namely Pfizer and Hospira, provided further tailwind for this outperforming sector. In terms of cross-market actions, the biggest bounce in oil price in 17 years, up some 20% from their recent lows, on the back of headline news that reported the biggest US rig cuts in 28 years, helped to lift the oil and gas equity segment. Indeed, after weighing on the overall equity market for several weeks, energy shares leads the market rally, attributing it to a rig count report by oil services firm Baker Hughes that provided evidence that US producers were meaningfully scaling back production. Likewise, US Treasury 10-year yield climbed strongly during the week, though still below the 2% mark, as strong job growth in the US, a rise in oil price, and an improved growth outlook in Europe helped to abate global growth concerns. Similarly, the US dollar advanced the most in 2 months versus yen, as a robust employment data fueled speculation the Fed will increase the US interest rates while its global counterparts add to global monetary stimulus. Last but not least, we also highlight here some key global events taking place this week that might offer more colors on the global growth pictures. In particular, early in the week, the G20 are meeting up to address issues centering around global turbulence caused by diverging monetary policies, followed by the Eurogroup meetings to negotiate on Greece's fate. Clients may consider using PhillipCapital to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. In addition, it may also trade based on different strategies using many more benchmarks available with Phillip ETF. Thank you for watching this week's Market Watch. Please subscribe to our PhillipCapital YouTube channel for new videos every week. Tune in for more Market Watch videos.